morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Pavitra Parekh and Surbhi Upadhyay, and markets under severe pressure, right? The Sensex is tanked 200 points. Sorry, the Nifty is tanked 200 points. Sensex lower by 650 points, dragged down by banking names. The Nifty Bank is under pressure, underperforming with a cut of nearly 2%. The Nifty has given up its 100-day moving average, which was at 17,950. Now the next level to track will be the 2023 intraday low of 17,761. We're still about 150 points away from that level. There is a distance, but that will be the next level to track on the way down, 17,761. And this leg down has also come in as a bit of a surprise because Asian markets are holding up fine. The ones which are trading, that's the Japanese and the Korean markets, are currently in the green. So there's no pressure which is being exerted, at least from the global cues per se. There is expiry today, but a lot of people thought that the expiry would end around 18,000 to 18,100 because while the broader range for the markets has been that 18,250 to about that 17,700, 750 thereabout. Over the last couple of days, the markets have been finding a floor around 18,000, and that floor has been taken down. The Adani Group stocks are selling off. Adani Ports, Enterprises, Adani Wilmar, Adani Power. HDFC Bank has declined after 6 days of gains. So there is profit booking visible over there. Consumer names, a lot of them reported numbers yesterday post-market hours. And barring HUL, which came out last week, most of the consumer numbers have been a bit disappointing. So it was Asian Paints last week. Today you had Pidilite, United Spirits. Yesterday, Colgate's numbers too were a tad bit subdued. So those are a few names that I wanted to bring up on the table. These are not the weak, moves today. Today, HUL is holding up. But broadly, the earnings from the consumer side, where the valuations are high, have not been great.
Yeah, I mean, if you just take a look at the earnings scorecard over the last 24 hours and the market reaction, it's far more red than green, especially in the broader markets. So completely take that point. I think also, Reema, what you're saying about the expiry, that's definitely, I think, exacerbating the moves. Yesterday as well, whatever we were seeing on some of these auto names, for instance, was more short covering than actually fresh buying that came through. So two big events. You've got the Fed announcement on the first. You've got the budget on the first. So perhaps you will want to sort of close out some positions and then take a fresh guard once they have more evidence with these two events. Just a very quick word on mid-caps. Mid-caps have been underperforming the Nifty, not just today, but over the month of January as well. And there's a broad sell-off. Triggers could be earnings, or basically just simple sentiment. But some names to throw up: Zomato, Granules, Quick Heal. All these stocks are down between 4, 5, 6%, depending on what you're looking at. Delta Corp, and then some of the bigger names, the bigger mid-caps. I mean, Ambuja, BOB. Indus obviously is reacting to a lot of the news that you heard post-market hours yesterday. But the short point is there's pressure all around, especially in the mid-caps. It's being felt even more. So let's move to the only green space then, Pavitra, the one that you're tracking. What are you looking at in autos?
Well, I mean, like we were talking about, the earnings reactions, at least for a lot of the top names, have been good, right? So you had Maruti, which, today also it's the top gainer. Yesterday it saw good gains. TVS Motor, even though the market is tanked in the past couple of minutes, that one is pretty much at the high point of the day. So a lot of these looking good. Bajaj Auto and Tata Motors post their earnings today. It's expected to be a weak set for Bajaj, yet it's holding up in the green. So we'll see how that goes. I think for Bajaj, the concerns pretty much remain the same. It is what is going on in the export market. So there is weakness expected on account of that. We're expecting around a 16% decline in volumes. So that'll be important to watch. But Tata Motors is something where we're expecting good growth to come across in the India business, in the JLR business. So that is something that we're going to watch out for as well. But take a look at how these autos companies have fared so far, in the month of Jan. So the figures are up on your screen. Something like a Tata Motors is up almost 9%. You have Bajaj Auto, which has done well. Maruti, which is up 4.5% right now. So I guess it's also, it'll be important to see how these fare now. Is a lot of the good news already in the price. Are we going to see more of a rally from here? That's something that we will be tracking. By the way, a lot of the auto-related stocks also, something like a Sona Comstar, you have Car Trade, all of these also doing very well. This is the weekly move, by the way, that we're seeing on some of the auto-related companies. So important to watch this space. But Reema, I guess the biggest cue is what you were talking about before the show, which is that tomorrow is a holiday.
Absolutely, right? We're all very excited that tomorrow is a holiday. We come back on Friday. We'll be prepping for the budget, but then we go into a weekend again. But we've got so much to track on the show, right? A flurry of earnings on the mid-cap end. So let's invite South Indian Bank. The bank posted its third quarter numbers with slippages at an 8-quarter low and interest margins the best that we've seen in the last 31 quarters. Murli Ramakrishnan, the MD and CEO at South Indian Bank, is now with us on the show now. Mr. Ramakrishnan, morning. Rima here. Do you think you will be able to sustain NIMs at these levels? Because as deposit repricing takes place, NIMs are expected to come under pressure. Could you give us an indication on your outlook on NIMs? How long do you think it will sustain? When do you think it will start declining? And to what extent can we see a decline in NIMs?
Good morning. This was the same question I think we had when we were actually meeting up during Q2 results. So that time also, if you recall, the repo rates have started moving up for quite some time, and it's moved up by almost 2.25%. So clearly there was a debate about how this will be impacting banks and how this will be impacting specifically our own bank. At that time also, I remember telling that as a bank, we should be continuously monitoring the NIM, and we should be continuously monitoring the rate at which we raise our liabilities and the rate at which we price our assets. So I'm happy to say that we are continuing to be doing quite well on this front. And if I were to really look at my cost of deposit, has gone up only by 4 basis points compared to what I had in Q2. And overall, the NIM, as you can see, is the best ever NIM we have had. And I gave a guideline of 3.2% by March, and I'm happy to say that we are pretty much near that even now. 3.17 is my NIM as I'm talking to you today.
Mr. Ramakrishnan, good morning. Surabhi here. So that's on margins. I just want to get your take on asset quality. Slippages have been declining, but if I look at the gross NPA level, that's still some would argue on the higher side at 5% plus. What are you seeing on asset quality, and what are you seeing on the recovery front? Your watch list has been coming down as well. The restructured book has been coming down. So just give us some more color and contours within asset quality and what we can expect, say, over the next 1 or 2 quarters.
Yeah, sure. If you recall, I took charge from October 2020. That's when we started actually building the new book, and we had to completely rehash the way by which we were streamlining all our products and businesses. So I'm happy to say that from October 2020 to December 22, we have added 37,000 crores of new book, in which my NPA is 0.06%. So what I'm trying to do is I'm actually adding high quality new book, which I've been doing not now for over the last 9 quarters. And we have been continuously working on correcting the past not so good quality book. That's where you should see our collection and recovery efforts. We have done a fantastic job in terms of recovery and collections. Just to give you some numbers, as of March 21, we collected and upgraded about 600 crores. The year ended March 22, we collected and upgraded about 1,500 crores. And in the year end, likely to end by March 23, we are expecting it to surpass even 1,500 crores by a good margin. So overall, I would say the strategy is to clean up the past book and continuously add a very high quality new book, so that overall you will see the provisioning coming down and down, and you can see the contribution of provisioning from the new book is hardly anything.
Sure. So, Mr. Ramakrishnan, completely take your point that obviously, since you've taken on, as you're saying, obviously you're building a much cleaner and healthier book, but shareholders will look at the aggregate at the end of the day, right? So, some guidance perhaps on, you're at around 5.5% gross NPA. Are you looking to come down to, let's say, 4.5%, at least reduction by what, 50, 100 basis points in the next 6 months?
Good point. I've been giving a guidance of closer to 5% by March end, and net NPA closer to 2% by March 2023. And I'm sure as we go forward, we are looking at much better numbers as we pan out for the next year, because by then the complete most of the new book would be actually predominantly be present in my portfolio. To that extent, you will see the percentage also coming down. But it's a game which we need to have patience. Because as you know, the recovery and collection from the book, which has been built over long years, will not come down overnight, and we will have to continuously keep increasing our recovery and collection efforts. At the same time, not letting any more new addition of bad loans to come in. So this is a process, and this process will take its time. I'm happy to say that it's come down from as high as my GNPA. If you were to look at some of the past quarters, my GNPA used to be as high as 8%. 8% to 5.448 is what you're seeing now. So 5.48 will come closer to 5 by March, and obviously it will go to sub 5 closer towards a 4.5% and 4% in the next full year. So that's how we are planning to bring down the overall NPA numbers.
Right, that is on the asset quality. Thanks for joining us, Mr. Ramakrishnan. This is Pavitra. On the loan growth, that's looking quite good this time around. It's at, almost 20%. But if I look at the past few quarters, there's been a lot of fluctuation. Can you tell us what is a good loan growth amount that we can expect to see going forward as well?
No, in the past few quarters, if you had to look at from April onwards, our growth has been in good double digits, and we've been growing at about 17-18%. That's though I've given a guidance of 12% for the full year, but we've been continuously surpassing that guidance. And we are continuing to grow. Actually, we started growing our book after my complete rehashing of my asset and liability business, which got completed in December quarter of last year. We started actually growing our book only from December of last year. So we ended March 22, we ended with a 4% kind of growth, and the year ended 23 March, we are expecting to be at least 12 to 13% kind of growth in the overall asset. So it's been a growing trajectory for me right from the time we completely rehashed the entire business structure.
Mr. Ramakrishnan, we'll leave it at that. So South Indian Bank guiding for a loan growth of 12 to 13% for the full year, though they have been exceeding it. Gross NPAs to come down to sub 5%, net NPAs to come down to 2%, and the company is saying that the net interest margins will hold at 3.21% by Q4 FY23. That was the guidance they had laid out 3 months ago, and the company is reiterating that. Strong showing. The stock is up nearly 4% in trade. We will slip into a very short break. On the other side, as always, we'll discuss what's buzzing in commodities. We'll invite Manisha Gupta.
CNBC-TV18 presents Mutual Fund Funders.
Direct equity allows investors to make their own investment choices and make purchase, sell and hold decisions. Mutual funds, on the other hand, puts the onus of stock picking in the hands of professional experts. So, what you get is a diverse basket of stocks at a relatively better risk-reward equation.
CNBC-TV18 presents Mutual Fund Funders.
आज तबीयत ठीक नहीं लग रही, तुम ही सब काम निपटा दो ना।
Welcome back. You're with us on Trading Hour. It continues to be a fairly downward drift for the market. Let's figure out what's happening in the world of commodities. Manisha Gupta is joining us for that as always. Manisha, what's happening in your world? Ours is mostly red.
Well, a bit of a green continuing in the metal space especially. And while copper, aluminum continue to trade at a 7-month highs, we've seen iron ore prices continue to gain as well. And this one is trading at a 7-month highs as well. Well, actually, when you look at the month of January in 2023, we already are up by nearly 7% for the prices here. The China zero COVID policy and the markets believing that the housing construction numbers will start to begin. The kind of credit lines that the commercial banks have opened for the property also have in turn turned positive sentiment for the iron ore prices there. And the markets also are looking at the adverse weather in producing countries. Brazil, for example, has seen cyclones and floods as well. And the first quarter maintenance for many of these iron ore plants in Australia also have led to lower delivery. Check out the import numbers for China, and that have been quite positive for the month of January until now. The markets do anticipate 115 million tons of import for the month of Jan. December was quite weak at nearly 90. November was 98, and we did see 94 for the month of October as well. So while there has been that jagged history when you look at the imports, but January clearly giving you a very strong number suggesting that the prices and demand both can be positive.
All right, Manisha, thanks a lot for that quick update. With that, we are going to get into a short break now. But on the other side, we're going to have the management of Chalet Hotels joining us. Managing Director and Chief Executive Officer of the company, Sanjay Sethi, will join in just a bit to talk about the Q3 earnings. Welcome back. You're still tuning into Trading Hour. It is still looking extremely weak for the market right now. All sectoral indices in the red. We're seeing a near 200-point cut on the Nifty right now. So just slightly off the day's low. And it is the mid-cap index and the banks which are actually seeing a bunch of the pain. So the banking index, the Nifty Bank is down over 2%. You have the mid-caps also which are looking at an almost 400-point cut. But let's talk about some individual companies now because they're in focus after their earnings. Chalet Hotels is on our radar. The company posted a strong performance with revenue up 17% sequentially. I don't want to compare it, versus last year because we still did have a little bit of the COVID impact at that time. Occupancy for the quarter came in at around 75%. So we have Sanjay Sethi, Managing Director and CEO at Chalet Hotels, joining us now to take some questions on the earnings. Mr. Sethi, good morning. Thank you very much for joining us. This is Pavitra. We were just talking about the numbers, but can you tell us how occupancy is looking now in the, in the past couple of months? I know for Q3 it was 75%, but that's also a seasonally strong quarter for the company. So can you tell us how occupancy levels are looking in the past couple of months? Mr. Sethi, I think you're on mute, so if you could just take that off.
Apologies for that. I said good morning, Pavitra, and the ladies in the panel. We're very happy with the best ever quarter that Chalet Hotels have had in the history of the company. So we're excited about that to begin with. In terms of the key numbers, I think occupancies were at 65%, not 75% for the quarter, but that was driven by the fact that October is typically a weak quarter for us when the holiday seasons happen. In October, we lost 18 days, and then December, we lost 14 days. But overall, extremely gratifying quarter where sequentially, our revenue was up 18% without the one-off entries, and EBITDA was up 35%. We've been able to actually clock that at 5.5x sequentially, which is, again, extremely gratifying, as I said. The strong part of the story is the rates are finally up, and they've been going up 3 consecutive quarters now. In fact, the growth over the previous quarter on the average room rate was 28%, which is really heartening for the industry. It seems to be holding there. We've seen that happen for 3 consecutive months now. F&B revenue is up 20%. And overall, a very positive story. And, because now this has happened for 3 consecutive quarters and we see this quarter panning out well too, I think we are on a roll over here.
So what is the kind of occupancy that you're seeing right now?
So this month is going to probably close in the 70s. But the rates continue to be northwards of 10,000 rupees, which is the highest that we've had since the global financial crisis now.
And the advance bookings that you have for February and March, should we expect occupancies to stay above 70%? And you're a little bit more about the pricing. It was at 10,168 in Q3. Does it stay at the same levels, or do you think you can push it up for the 4th consecutive quarter now?
So, Rima, you've seen the rates holding. We are at 10,000 plus this month also. February will probably be stronger than January, so we see occupancies being in the high 70s there, and the rates should continue at a 10,000 plus point. March will stay again very strong, so February and March look very, very healthy and strong. I think we are now reaching a point where this is now the new normal for us, where the rates are going to be in the 5 digits.
Okay, got that. Mr. Sethi, hi, good morning. Surabhi here. Yeah, ask some of your customers about that price increase, right? ARR 28%. We know even before you tell us, but okay, that's on the lighter note. Give us some sense on the corporate side as well. For the longest time, we would always talk about how events are not happening, corporate side is absolutely quiet. How has that picked up? Are you expecting a lot more traction? And what's the corporate contribution now to the revenue? And just a quick word on margins. They're looking very, very robust at 39%, but are they sustainable?
So, I think it's been over a year that I've been saying that corporate travel will come back. And we've actually seen that come back over the last 2 or 3 quarters now. We are actually above normal on the corporate travel segment. So clearly that's back and it's here to stay. Similarly, with the MICE business that comes from corporates, whether they're meetings, incentives, and conferences, they're back with the bank too. The social segment with the weddings, etc., is back very strong too. In terms of margins, yes, we actually had a margin of 41% last quarter. We expect that to be sustained. We expect basically Chalet to perform at 40 and above on an annual basis going forward.
Okay, Mr. Sethi, you also had a lot of rooms which you're adding. So I think 90 rooms at Novotel. You have around 170 at the Westin as well. Can you tell us what is the additional revenue that you would expect from all of these rooms which, which are being added, and what is the timeline on this?
So we expect to operate the additional 88 rooms at Novotel at Pune perhaps by end of February. So we'll get some of it in this quarter. The rooms at Hyderabad, which are 168, it's the new hotel actually, will get operational by early April. And we had 121 rooms under renovation at Hawaii, which have now been handed over in the next couple of weeks. We'll see them come back into operations. So we are seeing roughly around 300, almost close to 400 rooms that come into play starting April onwards, which will basically increase our inventory by about 18%. We see that having a very positive effect. And on a RevPAR basis, there's no reason that we will not achieve the same RevPARs that we achieve from the rest of the rooms. And the RevPAR in Q3 was 6,640, with a very high contribution.
You also have some office spaces which will come on board, right? In Powai as well as in Bengaluru. And that typically has higher margins. Could you give us an indication of what the consolidated EBITDA margins could be now that occupancy is picking up, your commercial spaces are giving you higher margins? What could we expect on the EBITDA front?
So Rima, we don't want to give forward-looking numbers, but we'll have at the end of this play around 2 million square foot of office space in operation in the next couple of quarters. The 2 million, or in that 2 million, about 1.25 million is in Mumbai. The balance, 1.5 million is in Mumbai and 1 million in Bangalore. Mumbai rates are going to be in the range of 120, 130. Bangalore's clocking around 60 odd rupees. And we typically have an 88 to 92% flow through on EBITDA margins from that. So there's a max to it. So the 2 million square foot of office space, 400 rooms almost coming into play almost immediately. This is going to grow the portfolio fairly aggressively. And we expect that not only to add to revenue, but also improve margins for us, both on account of the office space and the fact that the additional rooms will have lower fixed costs.
Okay. Mr. Sethi, quick last point then. You're hoping to operate at 40% plus margins, very aggressive inventory addition plan with, close to 400 rooms. Leave us with a guidance on debt as well, because that's been fairly sticky, northwards of 2,000 crores. So what's the plan? Will you be taking on a little more debt, leveraging the balance sheet as you go through the expansion, or would you be able to pare it down as we look at, the starting of the next fiscal?
So we're a very, very high growth company right now. Just to give you a reference on the debt side, we were at 2,234 crores on 31st March of last year. We are currently at 2,271, which is an increase of only 38 crores in 9 months, whereas we have put in 332 crores of new capex to fund the growth. So large amount of the funding of the growth is happening through our internal accruals. But we are not right now keen on paring down the debt because we want to continue to grow at a very rapid pace. There are a few more products which are coming in way. We've got the Delhi Hotel, which is going to start construction very soon. We've got a Hyatt Regency in Airoli with 260 to 280 odd rooms. That's going to start soon. And we may have one more office type Hawaii that come up. So all of these will require capital. We don't see us paring down debt for at least another year. And after that, as these capital works under progress start yielding EBITDA, we'll be able to pay down debt soon after that.
Okay, that point is well taken. I think 740 crore is the capex that you've outlined over the next 2 years. Mr. Sethi, thank you very much for joining in. That is Chalet Hotels for you. By the way, for the markets, we've taken a nosedive now. The Nifty is down 260 points. It's 17,850. So that 17,900 mark is gone. On the Sensex, it's a near 900 points fall, 1.5% lower, and there's been a vertical slide in the market, and that's courtesy many of these large cap names. So HDFC Bank, HDFC Limited, ICICI Bank is under pressure, and you can see a vertical fall in many of them in the last 10 minutes. All 12 constituents of the Nifty Bank are now trading in the red, with names like Bank of Baroda down 5%. All the sectoral indices trading in the red. It's the PSU Banking Index which is dragging the market 1,200 points lower. The advanced decline ratio has 2,400 stocks in the red. So this is turning out to be a fairly ugly expiry for us. It will be a good time to get in a few technical trading ideas, find out what Mitesh Thakkar has made of the fall that we're seeing. Welcome back. Adani Group stocks fall in trade today after Reuters highlights details from an Hindenburg research report on the group. Hindenburg says they hold short position in India's Adani Group via US traded bonds and via non-Indian traded derivative instruments. Reuters say Hindenburg expresses concerns over valuations, says over 7 listed companies of the Adani Group have an 85% downside on sky-high valuations. Hindenburg also says Adani companies have taken on substantial debt against shares, placing it in a precarious financial position. Reuters says the Adani spokesperson did not immediately respond to a request for a comment on the Hindenburg research report. Well, that entire group of stocks is under pressure, but now so is the market. As we highlighted, markets have taken a nosedive. It's 17,870 on the Nifty, 250 points lower. Mitesh Thakkar of earningswave.com joins in. Mitesh, till yesterday, markets were fairly directionless, and suddenly this is a decisive move lower. What, according to you, is the reason? Have you picked anything up? And what does it tell you about the way forward and where we are likely to close?
So I think one, the index has kind of gave a failed breakout yesterday, failing to sustain about 180, 200 levels. And now I think we're heading towards the lower end of the range. I think 17,800 should come into play again very soon. That is what I had the view in the morning, and we are not very far away from there. So I think back to 17,800. In case it breaks this time, then I think we'll look at some kind of continuation of the decline. But my sense that with the budget approaching, I think, and the event on the horizon, we might still be, chopping around in this range. So we're trading with more of stock-specific biases. On the stock side, I have a buy on Gas Authority of India Limited. Keep a stop below 98.5. Look for targets of 106. While Glenmark is a sell call. It's broken the 200 average as well. So keep a stop at about 409. Look for targets of 385 here.
Okay, got that. Mitesh, thanks very much. We do have to take a quick break on that note. And as we get into the break, it's time for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every single day. We will give you the question at 9:14 every day. Today, in case you missed it, we are repeating the question right now. And the question is, when did Nirmala Sitharaman present her first budget? The options are the 1st of February 2018, 1st of February 2019, July 5th, 2019 or February 1st, 2020. So send us your answers on Twitter. Post your answer as a comment on the question. Tweet to us at CNBC-TV18 News. Use the hashtag BudgetWithCNBC-TV18 and hurry and send us your answers. Remember, we will be announcing the winner at 3 p.m. today.
Welcome back. You're still tuned into Trading Hour, and let's get straight onto a special now. Like we've been telling you, CNBC-TV18 has compiled a list of top 20 stocks that you should watch for this year. This is a carefully curated list of companies that warrant a closer look in 2023. So Vivek is standing by at the big wall with the first stock from our list. Vivek, which one are you tracking today?
That's right. So today on my radar is a big player from the infrastructure space. So Larsen & Toubro is the one on my radar. It's actually seen as a bellwether and a clear proxy to the infrastructure and capital goods space within the Indian economy itself. The stock actually is enjoying a sharp surge and a thumbs up from most of the brokerages, and the stock is flirting near its lifetime levels despite a clear outperformance that we saw last year in 2022. So what we do is we analyze the internals and the various moving parts to check if the outperformance can continue in 2023 as well. In 2022, despite two key subsidiaries, that is LTI as well as LTTS, seeing a steep sell-off, L&T managed to outperform the Nifty by over 600 basis points as the core EPC business actually saw a sharp re-rating. Coming into 2023, we analyzed the key triggers and the brokerage outlook for L&T. Order inflows have been very strong with over 34,000 crores of order wins announced in Q3 as all of the segments have seen strong ordering activity. Oil prices at current levels is positive as the Gulf-based order win also has been quite strong. Companies focused on divestment of non-core businesses and a likely upgrade in ESG ratings is expected to provide a further fillip to the stock perception. CLSA in a note dated January 11th mentioned that for L&T, the stars are aligned for a solid 2023, as all of the segments are now firing in tandem. As per them, strong order inflow, inexpensive valuations, and double-digit growth in the core E&C execution will be the key triggers. CLSA also expects to see an ESG upgrade for L&T, led by its energy transition roadmap. Credit Suisse too is bullish on L&T, saying that with the strong order inflows in Q3, the EPC business re-rating will continue. In fact, Citi has opened a 30-day positive catalyst watch on L&T due to the expected healthy traction in order inflow announcements, revenue booking, and margins in third quarter. All of the brokerages now have a positive view on L&T, with Jefferies having the highest target price of 26.50 rupees per share.
Okay, all right. Thank you very much for that. Very, very interesting take coming in from the brokerages. Positive views. Those stocks had a good run. It is obviously trading at multi-year highs, but perhaps there's more upside and it's going to be a good year. That is what the view from the street seems to be. We'll take a very quick break on that note. We'll come back on the other side and get you more on the earnings front. We'll be chatting with the management of Sonata Software. Welcome back. Here with us on Trading Hour, and the next stock on our radar is Sonata Software. The revenue grew over 20% sequentially. Margins, however, slipped a little bit. We are now joined by Samir Dheer, Chief Executive Officer at Sonata Software. Samir, thanks very much for joining in. You know, we were just having a chat and Rima was explaining to us in the break about how sort of attrition obviously has been a big issue for most companies, including you. So first things first, you told us in the last quarter that you couldn't fulfill some of the orders because of this manpower issue. Has that eased out in Q3? What is the attrition number, if you could tell us that as well, your outlook, and whether now you're back to business as usual, at least on the employee front, to fulfill and execute orders?
Sure. Hello, everybody. First of all, thanks for the opportunity. I think Sonata had a very strong quarter in the quarter ending 31st of December. Just specifically to your question, I think the situation as it pertains to manpower in general is easing off. Is it solved fully? Absolutely no. I think there's still a lot of work to be done for market to cool down further from an employee perspective, but our attrition has come down. Prior quarter, we had seen an attrition of about 21%, but in the most recent quarter, the attrition has come down to about 15%. So it's a substantial drop. We have to watch the trend as we move forward as well, so that this trend can be sustained over a period of time. Having said that, the demand environment still remains pretty robust for Sonata. I think we have more position than we're able to fulfill even now. In the last quarter, we probably told you that about 15% of our demand is still going unfulfilled. That number has come down to about 12% now. It's marginally better, but there's a lot of work still to be done to gain the market momentum that we're already seeing from a demand point of view.
Okay, so 12% of your demand could not be fulfilled due to supply-side issues. Did you also face furloughs, which negatively impacted your revenues? And could you give us an indication of what Q4 will look like then?
Yeah, so I think the overall demand environment is pretty robust from a pipeline perspective, and the bookings that we've seen in the quarter, it is looking pretty robust. Our business is not impacted by furloughs. That doesn't impact us significantly. It's a small proportion, almost insignificant. As we look forward, I think the projections for the future coming quarter is also pretty robust. It will be pretty much in the line for what we have seen in the last 2 quarters. We'll end up delivering results around the same trajectory that we have seen in the past few quarters.
All right. Good morning, Mr. Dheer. This is Pavitra. You know, earlier you had told us that the wage hikes for FY23 will be in the later part of the year. So can you tell us how much of a hit on the margins you factored in because of the wage hikes? Because overall margins are down around 70 basis points, like we were just pointing out.
Yes, thanks, Pavitra. So the margins this quarter had a seasonality effect because we did some employee engagement activities and the travel has started happening post-COVID. So we believe there are some one-timers in our margin profile this quarter, which may not sustain, which may not be the expense going into the next quarter. So we'll have some recovery from that perspective. The second point is in the current quarter, in the January onwards quarter, we will have the wage hike impact coming through. And typically, we see about 2 to 3 quarters to recover that wage hike impact, which is pretty much will be the case this year as well.
So how much of a recovery? You said that, you are expecting some recovery on the margin front, perhaps because of some one-offs. It's at 6.9%. How much of a recovery could we see?
I won't be able to give you an exact number, but we probably see a reasonable amount of recovery. I think the quarter will see an impact of the wage hike, but about 20 to 30% will get recovered based on some of the one-timers we saw in the last quarter.
What's the wage hike impact in Q4 that you anticipate?
For the full year, we're expecting close to about 1.5 to 2% for the full year basis, the wage hike impact in the full course of the year.
Okay, got that. So that wage hike will wait. It'll have to be digested. Let's just talk about business momentum Q4 and beyond. Some color. I mean, is it going to be largely driven more by the products business? Also, give us an outlook on the IT services side, because that's where there is some margin compression.
Yeah, so the IT services side, the demand environment is pretty robust. We're pretty excited about what we see in front of us. The order book and the pipeline is looking very robust, and we're seeing a pretty comprehensive growth pattern. Sonata's differentiated offering as far as modernization is concerned, I think customers are embracing more and more, and that's what is really fueling the growth. And I think we had almost like an industry-leading growth in the current quarter or the last quarter, and we probably continue to expect to see that trend go forward as well. Now, just to give you some color, I think across industries we service the TMT vertical, which is telecom, media, and high tech. We've seen a pretty robust growth there. We've seen good growth in retail and manufacturing areas. We've seen a significant amount of growth in the BFSI area as well. So I think all the verticals that we have called out as our strategy will continue to see growth in those areas. So we are, I think, from a demand pattern perspective, by vertical, we're seeing a pretty significant momentum. Across geographies also, I think whether it's US geography and the UK geography, especially the westernized geographies, are seeing good momentum. And in Far East, Australia is a big market for us. We're seeing good momentum there as well. That's on the services side. And as far as the margin is concerned, like I said, we had some of the one-timers in this quarter, which will probably get largely remediated going to next quarter.
Mr. Dheer, we're out of time, but thank you very much for joining in. That's Sonata Software for you. With that, we're out of time completely on trading hour. The markets have recovered. We had gone down to levels of 17,850. From there, there's been a 50-point recovery on the Nifty. So currently, it's 17,900 on the Nifty, while the Sensex is down 700 points. But there has been a bit of a recovery from the lows. Thank you for watching this show from the entire team. Stay tuned. Halftime Report is up next.